take it away.
Thank you, Chip. You guys can hear me okay, I hope. Thanks again to Nadex. My name is Bob Iacchino. I am one of the co-founders as well as the chief market strategist for Path Trading Partners. And this is about an hour of your time to understand Nadex binaries and the concept of moneyness and the Greeks. This is part 2. We did have a little issue with the recording of part 1, but we're going to redo that again in the coming weeks, so you'll be able to see that again. But part 1 was a review of binaries themselves. So this is really the meat of what we wanted to talk to you guys about. So let me just go ahead and get started with everything. As always, before we begin, this presentation is for information purposes only and does not constitute investment advice nor an offer, solicitation, or recommendation to acquire or dispose of any investment or to engage in any other transaction. This presentation is not intended for solicitation purposes, but only for use as general information. All descriptions, examples, and calculations contained in this publication are for illustrative purposes only. The risk of loss in trading can be substantial. You should therefore carefully consider whether such trading is suitable for you in light of your financial condition, which I don't know, of course. Past performance is not indicative of future results. I always take a couple of minutes to kind of go into why these disclaimers are in all these presentations, whether it's from us or somebody else. And they are extremely important, and I like to touch on a section of the disclaimer in every webinar that we do. And I really like to talk excessively about past performance is not indicative of future results, because as a former fund-of-funds manager, and full disclosure, I still own a small percentage of a fund-of-funds. What else are you supposed to go on if not past performance? I see a lot of students and people who want to learn how to trade asking, hey, can I see your performance before I decide whether to learn from you or whether to listen to you? And of course, as a fund-of-funds manager, we examine past performance. But what that means, past performance, is not indicative of future results, is illustrated very well in the movie that's come out called The Big Short. So if you haven't seen The Big Short, I'm not going to get rid of any spoilers here, but essentially these guys placed a trade that something that would never happen before happened, or would happen rather. And it was really interesting the way that they portrayed it, because what these guys were placing a trade based upon was that an event that had never happened in history was going to happen. And it did, and their trade worked out and they made a lot of money. Not before a lot of pain, okay, and a lot of struggle and a lot of stress and some really big losses. But their trade eventually paid off because something that had never happened before actually happened. And that's what past performance is not indicative of future result means. Just because something has happened 10 times in a row or 100 times in a row or 1,000 times in a row doesn't mean it's going to happen again. And just because something has never happened doesn't mean that it's not going to happen. So it doesn't mean that you can't look at performance and make judgments. It just means that something has happened 10 times in a row. Don't put every cent you have available to trade in that it's going to happen the 11th time. That's essentially what that means. So there's our little disclaimer talk for this particular webinar. Path Trading Partners is a trading and education firm. We are also traders. PTP's mission was to form a trading firm that educates, supports, and backs traders who are committed to probabilities, discipline, and long-term trading success. This is achieved by following the correct path, hence the name. We are not high-frequency traders. We are not day traders. We are a firm that believes in long-term success in trading, covering time frames dictated to us by products, markets, and price action. What do I mean by that? Essentially, I mean that the markets dictate what we do. We don't go out and trade search. We don't go out and say, I want to trade a 5-minute S&P pattern today if one does not exist. We do not go out and say, I'm going to buy crude and hold it for 6 months if a particular pattern or price action model is not telling us to do that. The markets dictate what we do. That's what that means. Mike Arnold is a 23, Mike's with me here, by the way, Okay, so you guys haven't heard his voice yet. You probably haven't. 23-plus year market veteran. He's been teaching traders online and in person for 10-plus years. He has been and continues to be a strategy and development consultant to multiple hedge funds. He is a former options market maker on multiple exchanges. He traded in Chicago, in New York, in Switzerland, and in Canada, and he is the current head of technology and trading systems development for Path Trading Partners. And myself, that is me on the top right, I spent the last 23-plus years in the commodities, futures, and forex markets. I've been teaching traders and mentoring traders both live and online since about 2002. And to date, I've taught or mentored over 5,000 students, again, both live and online. I have appeared and continue to appear on multiple news channels. And to date, I've done over 700 interviews on various topics. And I continue to appear 5 to 10 times per month. For those of you that are listening to this live, I'll be on Bloomberg tomorrow morning at 7:10 Central Time. So that's an example of that. All right, so enough about us. Let's get to the meat of what you guys are here for. In the last session, we reviewed the basics of Nadex binary options. Again, there's a lot of information on the Nadex website where you can look at the basics because, again, we had a little problem with the recording, but we'll redo that one again. We then examined the concept of moneyness and how it applies to Nadex binary options. That you really can't find anywhere else. That's why we're going to redo it. We looked at the concepts of OTM, which stands for out of the money, ATM, which stands for at the money, and ITM, which stands for in the money. And finally, we took a quick look at how the price change of a Nadex binary option is not linear. In this session, we're going to take a deep dive into the concept of the Greeks. For those of you who have traded options before, you know what the Greeks are. You may wonder how they apply to Nadex binary options. We're going to dive deep into that. There is a lot of information in this session, okay, for those of you that have never studied options before, as well as for those of you that have. This can be challenging, all right? The first time a trader is exposed to this information, we don't expect you to understand all of it, but be patient. It may take a couple of times of reviewing this material for it to sink in, but you will have a light bulb moment if you're dedicated to learning this stuff. And if you're dedicated to learning this stuff, that's how you get on the path of long-term success. So let's talk about the Greeks. The major Greeks from the option world are as follows: Delta, Gamma, Theta, Vega, and Rho. A Nadex binary options trader should mainly focus on Delta, Theta, and Vega. Okay, there is Gamma, and Rho isn't really going to apply. We can apply these Greeks to Nadex binary options. The definition of each Greek is as follows. Delta is the sensitivity of the Nadex binary option to price changes of the Nadex indicative index. Gamma is the sensitivity of the delta to the price changes of the Nadex indicative index. Okay, not the sensitivity of the options, sensitivity of the delta. Delta covers the sensitivity of the option. Theta is the sensitivity of the Nadex binary option price to the passage of time. Some very important things that we have to bring up about Theta in the next session, not in this one. So focus on Delta and Gamma right now. Vega is the sensitivity of the Nadex binary option price to changes of the volatility of the Nadex indicative index. For those of you that don't know what volatility is, okay, volatility essentially is price expansion and the speed of that expansion of the Nadex indicative index. Rho is the sensitivity of the Nadex binary option price to changes in the interest rate, and we will not be looking at Rho. Since we are trading Nadex binary options on a short-term basis, and Rho will not affect the price of Nadex binary options the vast majority of the time. It'll be very rare where you guys are involved in a Nadex binary options trade and you'll be worried about changes in interest rate. Just isn't going to happen to you that often. There are some pricing model limitations, okay? The Greeks come from pricing models, and there are some limitations in those models. Those models make assumptions, and some of the assumptions are as follows. The direction of the underlying, or the Nadex indicative index, cannot be predicted consistently. That's one of the assumptions that's made in the model. The price of the underlying is log normally distributed. Okay? For those of you that don't know what log normally means, essentially it means it's a continuous probability. Okay? The underlying price in any time period depends on the price observed in the preceding period. That is an assumption made in the model. The model also assumes that traders are risk neutral and are indifferent towards risk. Now, we know that specifically to not be true, right? And commissions and fees are ignored. We need to go into the pricing model limitations because there are times where the models and the Greeks will not give you the exact change in price of your option and the exact sensitivity to the Greeks because of the limitations of the models. So in the following slides, we're going to be modeling different aspects of the Greeks. The price movement and values will be exaggerated to clearly show examples and help clarify the material. Okay? Remember, focus on the concepts and not the absolute values, which will be based upon implied volatility for the Nadex indicative index, and that varies from hour to hour and day to day. So again, focus on the concepts of the Greeks, not necessarily on the exact values we're giving in these examples. So before we do that, let's recap OTM, ATM, and ITM. Okay? Again, out of the money, at the money, and in the money. We refer to a Nadex binary option being out of the money if the Nadex indicative index is below the strike price of the Nadex binary option that we're looking at. Okay? We refer to a Nadex binary option being at the money when the price of the Nadex indicative index is trading at the strike price of the Nadex binary option. Okay? And we refer to a Nadex binary option being in the money when the price of the Nadex indicative index is trading above the strike price of the Nadex binary option. Okay, it's a simple concept, and we kind of need you guys to grasp what it means in order for us to actually dive deep into all the things we want to teach you guys. So here's a binary options price versus the Nadex indicative index. So we're looking at a 2010 strike price in the US 500. Okay? Here is the curve, the price of the option. All right? Down here on the x-axis is the price of the indicative index. All right? This is exactly at the money, exactly at 2010. That's at the money. So if the Nadex indicative index is trading at 2010, then the 2010 binary option is at the money. Anywhere below this is out of the money, and anywhere above it is in the money. Again, very simple concept. Okay? This is the way the pricing curve of the option would go, but we'll look at that again a little bit later. So let's look at...
I just want to say, Bob, real quick, and specifically that's with 30 minutes to go. That curve's going to change over time, and that's one of the things you'll learn about in next week's session, which is Theta. But right now, remember, these curves, and you can always look at the bottom of each graph, they're in reference to a specific time period until that option expires.
Right, so this is with 30 minutes left. I should have mentioned that all of these examples, as you can see on the next slide here down at the bottom, are what the curve looks like with 30 minutes left. So let's look at some of the Nadex option price changes. When the Nadex indicative index is at 2007, the 2010 Nadex binary option, again with an assumed implied volatility, is worth about $20. You can see that here. Here's the indicative index. You go up to the curve of the option with 30 minutes left. This curve represents the binary option price, and you go across to the left scale, and you see it's worth 20. Okay? At 2010, the Nadex binary option is worth 50. Okay? And at 2015, the binary option is worth 88. Okay, now this is assuming no real time has passed, since it's always at 30 minutes left expiration. Okay? As the Nadex indicative index moves from 2007 to 2010, the value of the binary moves from $20 to $50 with 30 minutes until expiration. So again, imagine if the underlying, the Nadex indicative index, moved from 2007 to 2010 very quickly. So there's still 30 minutes left to expiration. You can go across and see that the price changes about 30 bucks. The Nadex indicative has moved 3 points, and the binary option has increased by a value of $30, right? As the Nadex indicative index moves from 2010 to 2015, the Nadex binary option moves from 50 to 88 with 30 minutes until expiration. Okay? This is an example of delta. The Nadex indicative index has moved 5 points, and the Nadex binary option value has increased by a value of $38. So from 2007 to 2010, you had a $3 move in the indicative index, right? And you had a $30 move in the option. But from 2010 to 2015, you also had a $5 move in the indicative index, right? And you had a $38 move in the option, okay? That's an example of delta. I'm going to give the screen to Mike now to continue with this.
Thanks, Bob. Can everybody hear me now? Thanks for all that. So as Bob was going over, and you can also see in the curve, let me just jump back there 1 second before I get started. You can even see that this is not a linear curve. It has different slopes at different times. And Bob pointed that out by, 3 points, $10 a point, $30 versus 5 points would have, if it was linear, would have been $50, but it was only 38. And you can see down here, like if we go from, let's say, 2000, which is worth like almost 0, and we go to 2005, which is 5 points, it's maybe worth 10. So here we went 5 points, it only went up $10. So it really matters, again, out of the money, at the money, in the money, how much that option price is going to change. And then again, specifically at a certain implied volatility, which can also change, and a certain time, and time's always changing. Every second goes past, times change. Every minute that goes past, this curve actually changes. So the concept of delta. Let's go over the definition once again. The sensitivity of the binary price to price changes of the Nadex indicative index. Please keep in mind as we go through all the following graphs, they are simply a representation of the Greeks and not an absolute value. We're going to keep stressing that. Don't try to write down at this time, based off this indicative index, the price should be exactly this, because, again, it's at a specific time, which is always changing, and it's at a specific implied volatility. And there's implied volatilities also change minute to minute and day to day and hour to hour. So there's lots of these components. Really what we want you to focus on is the way these graphs look and where they're the highest and where they're the lowest. And we get into how the volatility changes affect the shape of the graph and how the time changes affect the shape of the graph. That's going to further deepen your understanding of the price movement of these binary options, which is really important because then you're going to be able to make better trade selections. You're going to know what kind of option over time as this information really sinks in, which option to choose, where should I choose an in the money, should I choose an at the money, should I choose an out of the money, based off of how I think volatility is going to change, or how, based off the time left to expiration, and where these spike and how the curves change as it approaches expiration. That's really the goal here. So the absolute values depend on the volatility, Nadex indicative index price, and the time until expiration. I'm just going to keep stressing that because people get too caught up in the number and say, I need to know the number. You don't need to know the number. For example, in this delta graph, this is now with 15 minutes ago, and we're looking if the indicative index is in the 2000, so we're roughly modeling the US 500 indicative index. This is a 2010 strike binary option, so 2010 would be at the money. What's the first thing we notice? The delta is lowest when it's out of the money or when it's very deep in the money. And as it approaches at the money, it peaks, and as it falls away from at the money, it goes down, but it's still positive. So what's this telling me? This is telling me when we're way out of the money down here, around the 2003, 2004 level. Let's say that. Our delta is low, so a 1 point increase in the indicative index is only going to lead to a small increase in the price of the option. However, when we're around closer to at the money, let's say around 2009, a $1 increase in the index, in the indicative index, is going to roughly increase it on this scale about $13. At the money, it would increase it over $14. But as we get in the money, let's say we go down to 2013, and this is still with 15 minutes left at a certain implied volatility. As we go farther and farther in the money, like 2013, a $1 change in the indicative index is only going to increase the option price $8. Now you notice how all the numbers are positive, and we'll get into that in a second. So, the key takeaways of delta versus the Nadex indicative index price. The delta is the highest when the Nadex indicative index is at the money. All right? Delta is lowest either deep out of the money or deep in the money. The delta rises as the Nadex indicative index approaches the strike price, as it approaches at the money, in other words. Delta begins to fall as the Nadex indicative index passes the strike price and moves farther away from the strike price. It is more important that you understand the key delta locations we just examined than the absolute value of the delta at each point. Let's take a look at what the different values of the delta mean now. If the delta of the Nadex binary option is 8, then as the Nadex indicative index changes by $1, the value of the binary will change by $8. If the delta of the binary is 14, then as the Nadex indicative index changes by $1, the value of the Nadex binary option will change by $14. Delta is directional and always positive. This means that if the delta is 10 and the Nadex indicative index moves up 1 point, the price of the Nadex binary option will increase by $10. However, if the delta is 10 and the Nadex indicative index moves down by 1 point, then the price of the Nadex binary option will decrease by $10. So it's always, you're taking the direction of the index, and that's the direction you're applying the delta. So if the index is going down, you're subtracting the delta value from the price. If it goes up, you're adding it to the price. Now, as we said, we've been stressing repeatedly, this is at a specific time. Why do we stress it's at a specific time? Because here's a graph of the delta for the 2010 strike binary option versus the time to expiration. So with 60 minutes to go, you can see this light blue line at the very bottom. So we're right at the money. Let's say we're right at this 2010. With 60 minutes to go, the delta is low. It's under 10 in this. As we get down to 30 minutes, you can see it creeping up at the money. And this is right where I'm looking at right now, the at the money price. As we go to 15, it creeps up even more. So if the price of the indicative index does not change and just sits there at that strike price, at the money, just as time changes, the value of the delta is going to increase. Look at what happens at 1 minute. You notice how it just starts spiking into 1 minute. Let's say, that could be 2 minutes, 3 minutes, but as it really decreases, and you've seen this if you've been watching the price changes of these binary options as they get really close to expiration, when you don't know if it's going to expire in the money or out of the money, or be worth something, be worth that $100 or be worth that $0, you can notice major price fluctuations with very little movement in the indicative index as it approaches expiration. That is a clear example of this delta spike, because you notice how it comes in. You can see how it gets closer and closer to the at the money price as it approaches expiration, and it gets a higher and higher peak. That's because any little change in that indicative index is going to drastically change the price with very little time left. Again, don't worry about the absolute value. On this model, with this implied volatility, with 1 minute to go, any 1 point move is going to change the spread or the binary price by approximately $55. So if it goes from even little ticks, like going from in the money where it's going to be worth $100 to at the money where if it expires there, it's going to be worth $0. Just that little tick is going to drastically change the price with very little time left. However, with 60 minutes to go, it's not going to change the price that much because it has a lot of time for any outcome to occur. The key takeaways of delta versus time. If the Nadex binary option is at the money, the delta will increase as the time approaches expiration. If the Nadex indicative index is below the strike price, the Nadex binary option is out of the money, the delta will generally decrease as time approaches expiration. I'll just jump back to that graph real quick. So, as you see out here, maybe about the 2005, 2006 level, as we approach expiration, the delta starts dropping and dropping and dropping further and further away. All right? That is the point to this. As it gets, as it drops further and further down, because there's less probabilities that any outcome will happen as the time approaches 0. Now, if the Nadex indicative index is above the strike price, the Nadex binary option is in the money, the delta will generally decrease as time approaches expiration again. Well, why is that? Because there's less possible outcomes. If we're way up here around 2015, and we're getting down from 60 minutes to 30 minutes to 15 minutes, and we're staying up around this 2015, there's a lot more probability that, hey, this thing's going to end up at its full value of $100. So minor price changes aren't going to change the value of the binary that much. But as you get down to this 2011, 2010, 2009, price changes are going to rapidly change the price of that binary option because as it goes to possibly in the money, the option price is going to increase drastically. If it starts falling away, going below at the money to back out of the money, the price is going to decrease rapidly with very little time left. Take another look at this. Now this is assuming a constant time, let's just call it, 15 minutes to go to expiration. I didn't label this chart, but let's just call it 15 minutes to go to expiration. This is with volatility changes. So we're holding time constant and we're only changing the implied volatility. Now, let me just touch on one concept. Implied volatility is different than actual volatility of the underlying. They're tied together in if the actual volatility of the underlying is going up, generally implied volatility is going up. However, implied volatility is an input to a pricing model that the market makers use. Let's just say that I expect a big report to come out, or a Federal Reserve announcement, or something, or something crude that's really going to move the market. And I know that report's coming out at 10 a.m. Well, let's say price just doesn't move that much because everybody's waiting on that report to come out. As an option market maker, if I think there's going to be a lot of volatility from that report, I can start increasing the volatility, the implied volatility of my model. Even though there's not a lot of volatility yet in the marketplace, I can increase the implied volatility of my model. That's also going to change. First of all, it's going to change the price of the binary itself, plus it's going to change the delta. So with any little price change, it can have more or less effect if the implied volatility is going up or down. So in this example, if we have very little implied volatility, down at the 5% range, and we're at the money, the delta has a large value. Little price changes have a big effect on the binary price. Versus if we have higher implied volatility, up around this 40%, price changes have less effect on the implied or less effect on the binary option price. Now, you might be wondering why that is. Let's take a look at some of these concepts, and then we'll get into that. The key takeaways of delta versus volatility. If the Nadex indicative index is at the strike price of the Nadex binary option, meaning at the money, the delta will increase as volatility decreases. If the Nadex indicative index is below the strike price of the Nadex binary option, out of the money, the delta will generally decrease as volatility decreases. If the Nadex indicative index is above the strike price of the Nadex binary option, the delta will generally decrease as volatility decreases. Why is that? Well, if we have lower volatility or lower implied volatility, any little price change, there's not a lot of options that can happen. When it's a low volatility market, the price does not move that much. So any little price change can have a big effect of the price of the option because you're not expecting the price to move that much. Versus when there's very high implied volatility, the price can whip around a lot. The outcome is a lot more uncertain of where this option will end up, whether it will be out of the money or in the money. So it doesn't affect the option price that much. So key takeaway from this, lower implied volatility, smaller price changes can lead to bigger option price changes. Higher volatility, smaller price changes lead to less binary option price changes. Now, look at this. We're going to take a look at time and volatility, and this is again the effect of delta that time and volatility have on it. What do you see here? The curves are very similar. You can see this is the one based off time on the left, the one on the right is based off volatility. Well, as time decreases, the delta spikes. Why does the delta spike? Because there's less time left for any outcome to happen. There's fewer possibilities. Isn't that the true as the volatility decreases? There's fewer opportunities for the price to change. So with 1 minute to go with time, any little price change of this indicative index is going to lead to a very large option price, especially at the money. Same with volatility. Any minor price change at the money with very little volatility is going to change the price of the binary option a lot. You can see how time and volatility have very similar curves. That's why just learn the concepts about this. Again, don't worry about the values, the concept. Less time when it's at the money, or lower volatility when it's at the money, bigger price changes of the option. More time, more volatility at the money, not as great price changes of the binary option. So the key takeaways, let me reiterate, many of the graphs of the Greeks will look similar between time and volatility. You'll see this repeatedly. An easy rule of thumb to remember is that more time is similar to more volatility. Think of it this way. If there's more time until expiration or greater Nadex indicative index volatility or implied volatility, there are more possible outcomes. And the Nadex binary option price will act as such. If there's more possible outcomes, there won't be as big price movements. As you limit the outcomes, the price will change more rapidly, either up or down. That's key takeaway. If I could have you remember one thing. Less outcomes, which is lower volatility or lower time, when it's at the money, they're more severe, the price will change both up and down. Let's get into the concept of gamma. And we're going to go over this gamma pretty quick. It's more important that you understand delta, but for the point of completeness, we're going to go over gamma so you know we're not leaving anything out here. The definition of gamma, again, gamma is the sensitivity of delta to the price changes of the Nadex indicative index. A great analogy is to think of delta as the velocity and gamma as the acceleration, or delta is the speed and gamma is acceleration. So if you're driving a sports car or something, you know, your acceleration from 0 to 60 is going to be different from your acceleration. The rate of acceleration from 0 to 60 can change for 60 and 120, even though the price changed that 60, the speed of 60, or the velocity changed both 60 miles per hour, the way it got there was different. That's the gamma. Don't get too hung up on gamma. We're mainly including it for completeness. Here is the way a gamma curve looks for a binary option. Again, this is for a 2010 strike binary option with 15 minutes to go. This curve will also change as time changes and as volatility changes. And this is the gamma. So we're looking at gamma. So this is for every 1 point change in the indicative index. The gamma will change the delta by this amount. That's what this is plotting. So if we're at 2007 with 15 minutes to go with this specific implied volatility, if the indicative index moves 1 point, we can go up here to the curve and we go over and we see 3. That doesn't mean the price of the binary is going to change by 3. It means the value of the delta is going to change by 3. So if the delta, let's say, was at 20 when we were at 2007 and now we go to 2008, we'll know the delta is going to go to 23. If we go down to 2007 to 2006, the delta will go down to 17. So this does not have a direct impact on the price of the option. It does have a direct impact on the value of the delta. And then the delta has the direct impact on the price of the binary option. So for anybody who understands math, this would be the second derivative. Key takeaways of gamma versus Nadex indicative index price. Gamma is positive as the Nadex indicative index approaches the strike price and the Nadex binary option is out of the money. As the Nadex indicative index price approaches and passes the strike price, the gamma turns negative. Gamma peaks in the positive below the strike price and decreases as the Nadex indicative index approaches the strike price. Gamma peaks in the negative above the strike price and then begins to return to 0 as it gets farther and farther in the money. It's handy to look at these graphs side by side. So here's a delta versus the indicative index, and here's the gamma. And this is both with a specific implied volatility with 15 minutes to go. So you see how this curve steepens and steepens, gets steeper and steeper, and then gets less steep, less steep, less steep, but stays positive, keeps climbing and climbing. You can see that on this gamma curve. So as we're going from 2005, it's increasing at 2, then it's increasing at 3, and it peaks just above 3 for here at 2007. That equates to this delta curve getting steeper and steeper and steeper. Then you see how it flattens out. Well, this is the flat part. This is the gamma flat part. Now, it's still rising, but it's not rising as fast as we approach at the money. That's because the values are they're still positive, but they're going lower and lower and lower. So it's still adding to the delta as we're approaching at the money, the strike price. However, the curve of the delta is not growing as fast. It's getting less and less steep, which you can see over here in the gamma curve. Now, as we pass at the money, you can see how this is going negative. What that means now is it's actually subtracting from the delta. So as the price would keep going up, you're going to get negative gammas. So the price is going to go up. 1 point increase at 2011 is actually going to take away maybe about 2.5 from the delta. All right, the delta is going to decrease. It's still, delta has to stay positive, but it's going to subtract from it. Vice versa, if it goes down and this is negative, it actually adds to it. That's why, remember, delta has an always positive curve. Gamma can have a positive and negative aspect. You're going to apply it based off the direction of the underlying. So now you can see why the delta curve looks like this. It's because the gamma curve looks like this. It's not linear either. It depends on the steepness of the delta comes from the change of the curve of the gamma. How does gamma change first time? Well, we know how delta it had very large changes at the money with very little time left. Well, you can see that here with 1 minute to go. Look at the gamma curve, how it spikes. Because as you go from, let's say, 2009 to 2010, this gamma starts adding to the value really quick. But once this thing goes in the money with very little time left, the price doesn't, it starts dropping off rapidly. When it's out of the money, it adds. When it gets in the money, it starts subtracting, meaning the change of the delta drops off rapidly when it gets in the money, but when it's out of the money and there's very little time left, you're adding to that delta rapidly. You see, like, if it's at 2009 with 1 minute left, and this is going to go one more point, which would take it to at the money, it's going to increase your delta by roughly 35 for that point. And then that delta maybe went from 55 to 85, so that, which is therefore going to impact your price change of the at the money option that much with very little time left. That's the important thing to notice here. And it really spikes coming into less and less time. It's very, you can see as a 60-minute, 30-minute, 15-minute, the curves are very similar and pretty low. While you can't see a lot of, they're still adding to the delta here or subtracting from it here, but what you really need to know is, look, the reason you can't see much here is because of the scale that spikes with very little time left. And it shifts. It shifts to closer to the at the money values as you get time. So you see with 5 minutes to go, the highest gamma value is maybe at this 2008, the lowest is that's 2011. But as it goes from 5 to 1 minute, you're now, that peak is shifted to 2009 and really 2010. So it compresses it closer and closer to at the money as you lose time. Key takeaways: as the time to expiration decreases, the gamma begins to change dramatically and the peak and valley shift closer to the strike price of the Nadex binary option. This is especially true very close to expiration, and the delta of the Nadex binary option can change dramatically. So let's just take a look at this. Now it's side by side delta and gamma. You can see here the gamma with 1 minute left is drastically changing the price of the delta. So any little move in this index either adds or subtracts greatly from the delta curve. That's due to this gamma spikes. As with delta, the absolute value is not necessary to know. It is more important to understand where gamma is the highest and lowest, where it is positive and negative. If the Nadex indicative index price increases by $1 and the binary has a gamma of 2, it means the delta of the binary will increase by 2. If it goes in the positive, if it goes down, it's going to decrease by 2 if it's positive. If the Nadex indicative index price increases by $1 and the binary has a gamma of -1, then the delta of the binary will decrease by 1. Okay? Gamma versus volatility. Volatility or implied volatility also changes the effects of gamma. It shifts your gamma curve. So as you see, remember we talked about delta with lower volatility, close to at the money, has drastic implications to the price change of the binary option. Well, with low volatility, like it down at 5%, your gamma is higher or lower, close to at the money, because there's less possible outcomes. So it's going to drastically change the value of the delta, which is going to then drastically change the price of the binary option. However, as your volatility goes up and up and up, gamma lowers and shifts away from the at the money price because it does not affect the delta that much, and therefore the price changes of your binary option aren't as severe. Key takeaways of gamma versus volatility. Generally, gamma behaves the same in reference to decreases in volatility as it does the time to expiration gets closer. This is most extreme at lower volatilities, closer to the strike price. When volatility is low, any minor changes to the Nadex indicative index's price has a dramatic effect on the delta of the Nadex binary option, thereby resulting in price changes of the option. Here we can look at the time and volatility curves of gamma. Just as we looked at them for delta, they look the same roughly. The scales are going to be slightly different. Just take a look at the shape of these curves. It's all you need to take away from this. So as price goes down, it's the same as volatility going down. The effects of the gamma are more severe as we get at the money. Time goes down, the effects of gamma on delta get more severe as we get to at the money.
So in conclusion, this webinar we introduced the concept of delta and gamma in a fair amount of detail, and we examine how price, time, and volatility changes affect the delta, gamma, and Nadex binary options price. In the next time, or rather in the next session, we're going to finish up with the Greeks and look at Theta and Vega. All of this is going to play into how, when, and where a trader puts on a Nadex binary position. This is the important thing to get to. This will give you an inside track to establishing Nadex binary options positions that are specifically aligned with different trading strategies and designed to successfully capture specific market events. This is what learning the Greeks is about. It's not about being able to say to your buddy next to you, oh, you know what, that's probably got a delta of about 40. Okay, it's not about necessarily knowing the exact number of the delta, the exact representative number of gamma, okay, or in the next one of theta. It's about understanding why your trades behave the way they do, and then taking that and morphing it into, well, what's the best particular strike for me to put on right now? All right, one of the advantages of Nadex is not just the different strikes, but the different times to expiration, right? You may be looking at binaries that are all representative of strikes very close to each other, but they have different times. A particular strike at a particular time might be better based on your opinion of the market versus a completely different strike with another expiration, or versus a similar strike with another expiration. This is what understanding the Greeks help you decide, and that's what that last line here means. Okay? Establishing Nadex binary option positions that are specifically aligned to the trading strategies and designed to successfully capture specific market events. It's very easy for you guys to succumb to just picking direction. Okay, just picking direction is not the entire way, or rather it's not the best thing. There's a lot of times where being correct in direction, you'll be wrong in your trades and you'll wonder why. That's what the Greeks are about. So if you have a strategy that gives you direction in a high probability fashion, all right, which strike do you trade? That's what the Greeks are. That's what we're trying to get to. Okay, that's why we're diving deep into Greeks a little at a time. That's why we didn't just go, okay, here's what delta is, here's what gamma is, here's what theta is, go to work. Okay, because that's not how to succeed. We try to impress upon you guys over and over again that having a strategy is important, but you also have to know that you are trading options. And while Nadex is this amazing place that delivered these very simple and easy to understand binary options under a regulated environment with no brokers in the middle to screw you up, to cloud your mind and to overcharge you with fees. It's just an exchange, right? But they are options. And options have Greeks, and Greeks matter. So you need to understand these Greeks. We'll hang around for any questions, but in the meantime, I want to put up on the screen here again who we are and where you can find us, and remind you guys that a week from now, same time, same place, we're going to do part 3 of the Greeks, and again, we'll dive deeper into the other 2 Greeks and start getting into the ideas that you guys should understand what the Greeks are. Don't focus after this, and you're going to need to watch this again a couple of times, and you'll be able to find the video on Nadex's YouTube channel, and then we'll put it up at pathtradingpartners.com, a link to the Nadex channel as well. Okay? And this will also be on the Nadex homepage under Education and archived under Webinars. Okay, so you'll be able to find this one. But do not be discouraged if you're like, well, I don't know what all that means. Okay, you guys just did a lot of stuff and I don't really know what it means. All right, now we got our first question. And Sina, I remember you from the last webinar. Nadex platforms does not have Greeks. How do you use Greeks? Are you using different platform or software to trade the Nadex binary options? No, Sina, we're not. And again, you don't have to know exactly what the Greeks are. You just have to know that with 1 minute next to expiration, your delta is going to move quicker. You need to understand it rather than know the exact number of the Greeks. Okay, that's one of the things we stressed it in the last webinar. We're stressing it in this one as well. I'm going to stress it in the next one. You need to understand what the Greeks are and how they affect your trades, not necessarily the exact number. If you want to know the exact number, Sina, watch the way the price moves. And then you'll go, oh, okay, this has a delta of X. But as you start to understand the Greeks, you'll understand, okay, there's only 30 minutes left to expiration. This particular Greek is in the money. I know how the delta is going to behave. I know how the theta is going to behave. That's what's more important, not the exact number. Again, happy to take any more questions, or again, you guys can always reach out to us as well if you have questions on these webinars. Again, I know that this is a lot of information, a ton of information. Watch the recording, okay? In a couple weeks from now, we'll redo the first one, but the first one was just a basic introduction. This is really where the meat came in. So again, Sina, this is you don't have to know the exact number, okay? When Mike and I were on the trading floor, we were in different areas. He was at the SIBO and I was at the CME. But they used to give us option sheets in the morning. And I would look at those option sheets and I would have deltas and thetas and vegas and gammas for all the different options. But if volatility changed, those numbers all changed. So the sheets they gave me in the morning, those numbers didn't apply anymore. So again, it's about the concept and not the actual number, not the actual number representation. We'd be able to look at the sheets and know which ones had a delta of about 50, which ones had a delta of about 25, which ones had a delta of about 75. And then when volatility moved, we understood that those deltas were going to move with it. Any more questions from anybody? Otherwise, we're happy not to keep you guys around dinner time. It's entirely up to you. All right, guys, we're seeing the attendees drop off, and I'm not seeing any more questions, so we'll just call it a night. Again, you can reach out to us. I'll wait a few more minutes to see if any other questions come in. But again, a reminder, same time, next week, Tuesday, we'll do part 3 of this webinar. We'll dive more into the Greeks, the remaining Greeks, and that'll be it. So cheers, guys. Thanks again for being here. Thanks to Nadex. And we will see you guys next week at the same time for part 3 of the binaries, Moneyness and the Greeks. Thanks, guys.